So good morning and welcome to the BlackEarth Minerals Investor Webinar. I'm Jane Morgan, the Investor and Media Relations Manager, and today I am joined by Managing Director Thomas Rebbe. BlackEarth Minerals is a critical commodity specialist with advanced mining projects in Madagascar, base metal prospects in Western Australia, and several downstream graphite processing deals. Today we'll be running through an extract from the updated scoping study presentation for the company's flagship Mineri graphite project in southern Madagascar, which was lodged with the ASX yesterday. To ask a question throughout the presentation, please use the Q&A function at the bottom of the screen. Tom, I will pass on to you.
Thanks very much, Jane. I'm just going to run through basically, as Jane said, the highlights of the release we made yesterday, which the board and management are particularly happy about. In terms of those who are new to BlackEarth, I'll just do a quick one slide. We listed in 2018, so we're a tad short of 4 years as an ASX listed company. From that date, when we first started, the board decided collectively that what we wanted to do was become a material player in the global graphite supply chain. For a number of reasons, it certainly de-risked the growth of the company, but most importantly, it provides upside, and the leverage in terms of moving up the value add chain is significant, and we wanted to be able to provide that as an opportunity to our shareholders. We started with the Mineri graphite project. It's a project located in Madagascar, the southern part of Madagascar. It's a proven location. There's been graphite production and export from Madagascar for over 100 years. And in fact, one of the operations that started 100 years is still actually producing. So it's a known location as far as graphite production. It's in the top 4 producers in the world as far as graphite. And it's my belief that it'll probably move to number 2 within the next 2 to 3 years after China. A quality resource and large exploration target, we have, and I'll touch on the quality aspects later, but suffice to say that we've spent a lot of time, money and effort ensuring that the product that we can produce, given the material in the ground, is saleable and can attract, in some cases, some very attractive premiums. And the last large exploration target says that we're going to start in a number of stages, but the potential to expand, add further value, etc., is certainly there. We plan on still completing the feasibility study late Q2 2022, as in next year, and that the plant is being planned to be commissioned in 2023. It'll be modularised, sent into Madagascar, constructed that way to save construction time and construction risk. To that extent, and to deliver against our ambitions of being a vertically integrated graphite business, we signed a number of months ago the joint venture with Medichem. Medichem are an Indian private company. They have been in the expandable graphite production business for about 25 years. The product is readily accepted into international markets, and they're only at a small scale. So we give them the opportunity to upscale cooperatively in building a JV brand new facility to produce around about the 2,000 to 2,500 tonne per annum of expandable product. This will give our shareholders a significant uplift in respect to profit share. We already have a binding offtake with a tier 1 European buyer, being Graphite Bergbau, and that just sums up some of the market conditions as such that people are concerned about supply of raw material and also the being able to access some intermediate product such as expandable product. And the plan is to commission the plant and be in cash flow third quarter next year. So a very exciting 12 months coming forward for us. As I said, the graphite market is such as a chasm between graphite investors at the moment and end users. The end users are worried about security of supply, not just by way of quantum, but also by way of geopolitical risk. And we have regular discussions with a number of potential off-takers on top of the discussions we've already announced to the market. There has been a decline in coarse flake material, and that's seen prices rise over the last few years. And we're particularly excited about that because our entry into downstream is certainly going to propel us into the production stage and brand us as a graphite producer within the next 12 months. Again, just from a company point of view, we have 217 million shares on issue. We have an enterprise value of about 20 million Australian, or about $15 million US, and the $15 million US is relevant to the following slides in respect to its comparison to NPV and the rest. The people associated with the company, it's just an excellent blend of financial, commercial people. Heather, who joined us recently, has over 35 years in stockbroking, and we just started to make the inroads into her contact base, etc., which will certainly help with the company moving forward. George has been around since day one. He's got great credentials in terms of project development, critical commodities, and African experience. Dave Round is a real asset to the company. He's had first-hand experience in a graphite production company in Madagascar, but he also has the international contact base for sales through Europe, India, China, Southeast Asia, and the US, all the key markets as such. And my background is basically initially technical as a metallurgist, moved into operations, and then spent a considerable time in the project development area. So this is what we released yesterday and what we were particularly excited about. Our initial study back in 2019 gave us an NPV of US $103 million. We released the number of $230 million just on the Mineri project, which is a 126% increase. And that's been largely a result of the discovery that we made in Raspberry Northwest. I'll touch on that shortly. The NPV can be expanded further, incorporating the downstream processing and our short-term ambitions in respect to the Medichem joint venture, takes that NPV to $255 million US. As important also, particularly from a debt finance point of view, is the rapid payback. 1.2 years is comparable to, if any project anywhere in the world in any commodity that reports a payback of 1.2 years is a very attractive project and gives the banks and overall debt financiers a lot of comfort that they will be paid back as it's a low risk. The internal rate of return, which is a figure a lot of people pay attention to, is just on the Mineri project has moved from just under 42% to 86%. That's as good a number as what you'll find in any graphite project around the world. It certainly puts us at the top end of project development opportunities. And of course, as I mentioned, we updated our resource recently, not just by way of tonnage, but also by way of grade. And that, of course, has had a significant impact in terms of the financials. You'll see here that the original NPV in a bar graph form is 103 million. And that lift is, as I said, $127 million attributable to the uplift in NPV for the Mineri project, 25 million on the Medichem joint venture in India, giving us that very attractive total of 255 million or 223 million pre-tax. Again, on the right-hand side, the comparison is there. Our enterprise value, as I said earlier, is $15 million. And there's a gap there to $223 million, which represents the investment opportunity for current and potential shareholders. The updates, as I said earlier, the material increase in resource size and grade was the primary focus. And that's fantastic because as people who are following our story understand, we only drilled shallow in the northwest down to 40 metres. Most of the holes finished in graphite mineralisation. It was open to the north, south and east, as well as at depth, which means we'll be going in there next year from an exploration drilling point of view and adding to that high grade resource. So there's every chance that that NPV should lift, all things considered, even higher. ESG is very important to us. We see ESG as all about engagement with all our stakeholders and understanding the risks associated with the development and ultimate operation of the project. When I say stakeholders, it's shareholders, it's employees, it's government officials, and also very importantly, and for obvious reasons, the people whose lives we're going to positively impact on the site at Maneri and also in India. So that's our approach. The environmental and social impact assessment, the ESIA, on the left-hand side there will be done according to the IFC principles and World Bank standards. That's done for a number of reasons. One, it conforms with the environmental policies that the company has in place. Secondly, the feasibility study needs to undertake that as part of the development and ultimately its ability to obtain that final global permit, which will push us into the construction phase. We're looking at socially, we're looking at a number of things. Last week, we delivered another 5 tonne of food to the villages where we operate, because at the moment, sadly, Madagascar, and particularly in the south, is undergoing a famine, and that's having some dire consequences. So we're doing our best in terms of helping the people from food, water. We've historically helped them on a health basis. We built a medical clinic, and we're contributing to the education uplift of the local workforce and the children in the area. And of course, from a governance point of view, we hold ourselves completely transparent to the policies that we have in place and that you can see on our website. And we're adamant that we will follow those for not just regulatory reasons, but ethical and moral reasons. So the project itself, the new resource came out. You'll see in the bottom right-hand side of that table, you'll see the total quantum of 1.6 million tonnes, or thereabouts, of contained graphite in resource. You'll see the impact of the Razaphi Northwest there as well, and you can start to understand what it means when we get back into exploration into that area and the potential we'll have on the financials moving forward. All of that with an exploration target of 260 to 380 million tonnes really puts us in, and I've said this before, graphite domain as such, which is shown by those red lines. At this stage, that's our understanding of the graphite domain, but it's likely to stretch. Our tenements are not only just what is on that figure on the right-hand side, but they extend to the north and to the northwest. So there's plenty of upside. The yellow dots that you can see there, for those who can't read it, all represent rock chip samples going 10 to 20%. And you can see that we haven't done a lot of exploration, but we're certainly in a position where, from an ASX guidance point of view, we have more than 14 years mine life. And if you include all the other inferred resources, it's probably closer to 25. That area around the Razaphi area, that lower white oval shape, has a granted 40-year mining lease already put in place. And so the only thing stopping us from mining at this stage on that is the final grant of the environmental permit. And then the other tenements are currently being applied for conversion from exploration licence to mining licence. Those green areas also represent graphite outcropping. So for the purposes of exploration, you can see that it's very easy to find the material and to explore. And we have a good, proven and inexpensive way of exploring in the area and ascertaining priority areas. So lots more to come, I'm sure, from that side. These were some of the intersections that were released a couple of months ago, nearly 30 metres at 17.6, 16 at 16, etc. These are the best grades that Madagascar's ever seen, and certainly rate in some of the highest grades that you'll see in any graphite development or operation around the world. This is just the mine production. You'll see the influence of that grey line and yellow dots highlighting the importance of the higher grade material. When we first start, the bars below it represent the throughput, and you'll see that the plan is to go from 500,000 tonne to 1 million tonne, the expansion being funded out of operating cash flow, so that we don't dilute shareholders. That's our current Maneri flake size distribution. So you'll see that we're blessed with a fair proportion of coarse flake material, which is the very reason why we want to obtain maximum leverage on that product by going downstream sooner than later. What's really important and to understand is that what's in the ground predetermines ultimately what products you can really produce. To that extent, we've spent a lot of time, as I said earlier, understanding the sort of products that we can produce. We've gone to independent laboratories, we've gone to tier one end users, and we've had our material tested. And we continue to test our material. And certainly from a tier one perspective, we're getting sample qualification. So they're requesting larger samples to move forward to more binding arrangements. And that'll be done over the course of the next 6 months. You'll see that in regards to the expandables material in particular, we signed the joint venture, as I mentioned earlier, with Medichem in India. RHI Magnesita on the refractory side is the world's leading provider of high-grade refractory products. And we're the only junior that's actually signed a deal with their global procurement office in the Netherlands to be able to send material to the port in the south of Madagascar, and then the ships will just go to whichever factory requires the material. And finally, the lithium-ion battery side, we understand the specifications of the highest level requirements by the tier one end users in anode manufacturing, and we are actually delivering results that meet their requirements. In terms of expandable graphites, this was given to us by George Liu. It's a German company, one of the largest trading houses in graphite in the world. This is basically minimum standard requirements in this black series of black columns. And that's our material and the results that we achieved with no special additions, no special tests. It's just a function of the quality of the material that we have in the ground. So selling the material and downstream processing is certainly beneficial and will continue to be beneficial to shareholders moving forward. This is just a summary, if you like, a pictorial summary of the company itself. You'll see that there's a very low strip ratio when we first start the operation. It'll be closer to 0.3 to 1, but life of mine is 0.9 to 1. 500,000 tonne throughput, as I said, will be stage one, moving to 1 million tonne. That initial concentrate production of 30,000 tonne will probably be closer to 50,000 tonne, given the influence of the higher grade material and it being preferred when we first start. You'll see under the product section the list of 3 primary products that we're talking about, the sort of prices we're talking about. These are the applications, so we've been very, very focused on ensuring that our applications, our target applications, are actually realistic, and that's what we're basing the whole feasibility study on. And then we have various partners, and you'll see quite a few European Union related countries as well. I'm not going to go into the detail of this. You can find this on the release that we made. Suffice to say, all these people are quality people, and they range from US to Austrian to Indian companies. And you can see the relevant products that we're talking about on the bottom row. And that's kind of the way we're going to develop this project moving forward. This is our schedule, also released yesterday. We're currently undertaking an infill drilling that should be finished by the end of January, rain permitting. And then the DFS, including the improved economics, should be completed in that second quarter of next year. As part of the completion of that study, we'll need to obviously submit that to the Madagascan authorities in order to achieve final permitting and licensing. And of course, we'll be running in parallel with that the project financing strategy and looking towards implementing that late next year. But we're not going to lose momentum in terms of the project being developed. So as soon as we finish the DFS, we'll be moving into the FEED, or front-end engineering and design. And we'll also be looking to lock in the long lead items to ensure that we don't lose the momentum towards construction and ultimately operations. The impact of Medichem, well, the whole reason we're going down this path is we have been blessed with the right material to produce a high demand product. It's a low risk, low capex entry. Total capex is around about $3 million US, and being 50-50, our commitment is $1.5 million. That's progressing very nicely, and obviously there'll be more news to follow on that not too far away. What it does a number of things. It helps towards our ultimate goal of being a material player in the global graphite supply chain. It provides our shareholders with leverage on the upside, and we will be looking at other opportunities for downstream value add later on, but this is a perfect opportunity to take advantage of it. And thirdly, when we talk to the debt financiers, as well as having a quick payback, we'll be able to demonstrate that we are a partial off-taker for our own product coming out of Madagascar. Again, I'm not going to go through this in huge detail, but suffice to say that the NPV for the overall project and the IRR before or after tax is extraordinarily attractive, and that's what's on us. And again, it has a payback period by sheer coincidence of 1.2 years as well. So we're really looking forward to getting that into cash flow by this time next year. Just thought I'd put this slide in here to put it in context. This is from 2020, so it's a year old. Madagascar at 47,000 tonne is already a significant global producer of graphite. In 2021, our understanding here is that that number will be closer to 100,000 tonne, if not more. And we believe by 2023-24, that number could be as high as 300,000 tonne. So it's in a clear position. The quality is there. The financeability of projects is there. The acceptance by off-takers is there. And the reason it will grow is because there's a number of projects there. Tirupati is an Indian company listed in the UK. They're looking to up their output. Galwa, who already produce around about 80,000 to 100,000 tonne a year, are looking to increase that. Molno, owned by Next Source Materials, currently in construction and some 50 kilometres north of us, aims to be in production next year. And then, of course, we certainly have plans on being in production by late 23. Just in summary then, the uplift in the NPV and IRR is still as good as it is and as attractive as it is, still has upside by way of further delineation of high-grade material in that northwest area. We have completed an audit of the ESG components of the company, corporate project, etc. And that's going to be assessed, and the results of that assessment will be coming out in Q1 next year. As I said earlier, the plan is to complete the DFS by Q2 next year, and then we'll be putting out regular updates as to the project progress and the activities that we're undertaking. And of course, the rollout of the company's downstream strategy is clearly underway at the moment, with the commencement of commercial expandable production in India due in Q3 2022. So hopefully that's given you a good idea of who we are, where we're up to, and certainly the investment opportunity that exists for current and potential shareholders in front of us. Thank you, Jane.
Thank you for that, Tom. I might just get you to stop sharing your screen so we can jump into some questions. And
Sure.
Again, please feel free to use the Q&A function at the bottom of the screen, but Tom will jump into it. So is the infill drilling at Mineri, which is guided for early next year, expected to improve project economics further or just firm up the resource figures from indicated to measured?
Okay, so the pure purpose of the infill program is to convert as much of the indicated resource as we can into the measured category. For those who aren't familiar, measured ultimately becomes a proven reserve once as part of the feasibility and as the economics are applied, and the indicated moves into probable reserve. So that's the pure purpose. However, as we've been drilling, we've found that rather than continue to limit ourselves to the top 40 metres, we want to know what's further down. So we have been and will continue to drill down to depths of about 80 metres and so on. And one would imagine that will add further tonnage to the Razafi resource. And of course, by doing that, by pure implication, if you add more tons, you add more mine life. If you add more mine life, the financials will be impacted.
Thanks, Tom. And so just on that, so what's the measured resource tonnage considered optimal for the DFS and funding requirements?
Okay, so broadly speaking, and this will relate to any project that's out there, it's a chicken and egg thing in some respect. You have the banks and our DFS. The purpose, again, for the people listening, of the DFS is to be used as a bankable document to go to the banks and to obtain debt financing as a result of what's in there. So their ambitions when they're looking at it are A, conservative, and B, they want to know about payback. So if we talk about payback currently being about 1.2 years, they're going to want comfort on that. And we're going to, they'll probably look towards 3 years if they're getting payback in 1.2 years. So in 3 years, we would have treated 1.5 million tonnes. So one would imagine the optimal, from a pure theoretical point of view, would be about 1.5 million tonnes in the measured category. But as part of the infill drill program, we'll have much, much more.
Thank you. And just a webinar attendees noted, so it appears that the revised basket price is based on particularly conservative figures. So is that the case?
I don't think it's particularly conservative. I mean, we have, as I said, David Round here. He's constantly in the market looking at pricing, etc. I think what we are is realistic. And again, just reiterating what I said earlier, in terms of the DFS, the banks want us not to be over optimistic. Otherwise, there's another reason for them to increase cost of debt funding, etc. If we go in there with real numbers that can be substantiated by current sell price, then I think that's the responsible way of doing it. I am fully aware that some others quote higher prices. That's their prerogative, and that may or may not catch up with them later on when they enter the real world of production. But from our point of view, I don't think it's conservative. I think they're real figures.
Thanks, Tom. And just another one. So in simple terms, can you please explain the value gap that exists between BlackEarth's current enterprise value and post-tax consolidated net present value?
Okay. So NPV is all about understanding the present value in regards to present operating costs and present revenue outlook. And that's how you come up ultimately with a net present value. So that's the current value, if you like, of the project. And we're saying combined with the Indian project, it's probably about $255 million US. And the second part of the question relates to the enterprise value of the company, which is about $15 million US. And that came up on the chart earlier. The reason for the gap, well, the gap itself provides the investment opportunity. Is that a fair discount? Well, the market's out there. The market determines that, not me. So, from my perspective, we were surprised that the price didn't jump yesterday, but given the time of the year and people's other distractions, volumes down. So, I'm hoping that we'll see a pickup, particularly New Year as new news comes through. And also, we'll be working with the people in the IR/PR side of things, and we'll be doing even more of that early next year as we're allowed to leave, hopefully, Western Australia to be able to promote this company in more than just Perth.
Thank you. And so is BlackEarth on track to meet current timelines as last guided, and what outstanding product qualifications are still awaiting? Okay,
so the last known schedule we put out was a day ago. So I really hope it hasn't changed much in the last 24 hours. So no, it hasn't changed. The things that could impact us are, for example, assay results. And the wait here in Perth is about 6 to 8 weeks before we get assay results. What we've done is we've gone to an international laboratory, SGS, in South Africa, and they can turn those around in less than 2 weeks. So we're going down that path, but there's nothing to say that won't increase and could have an impact in terms of our feasibility study, access to the right people, because I don't just want anyone working on the project, could have an impact, but touch wood, we haven't had that issue so far. We certainly have a quality team. So whoever's asked the question, or if there's a number of people asked the question, I think that table we put out yesterday is fair and reasonable. In terms of qualification of product, we continue to move down that path, and we've got some really good feedback from various groups, and we're working with them in some cases to tailor our product to ensure that we get even a higher potential revenue stream. So that'll be ongoing, and we'll be making various announcements into the new year on that.
Thanks, Tom. And so can you please elaborate on risk mitigation strategies and any considerations to supply chain risks?
Okay. So in terms of risk mitigation, we actually did a full risk review before we listed in 2018. And to some extent, that's still in place, the actions that we're undertaking there. And they came out in a lot of detail in the initial prospectus, which came out in 2018. We have a full risk management program. Our project manager for the Mineri project, Nick Ryan, he's tends to be a conservative and risk-averse individual. So we're running a risk mitigation and minimisation program in parallel with that. Where are the risks? Well, the international equity markets look very top-heavy. The graphite demand curve and outlook for prices is pretty strong and certainly looks very attractive. And unless EVs and expandable graphite falls off the face of the earth, I can't see that being a significant risk, particularly because we invite realistic graphite prices. Madagascar itself, look, it's an African country. Having said that, we've got great relationships. Our country manager is the chairman of the Madagascan Chamber of Mines as well. So we're well connected both at government level and with other mining companies in the area, including the Ambatobe project with Rio Tinto. So we constantly review these things. They're brought up at every board meeting. Where are the risks? What are the current risks? What are the new risks, etc.? Plans are put in place on the basis of that.
Tom, so just for the scoping study, is the NPV and IRR assuming 100% equity funding or a combination of debt and equity?
It's purely equity funding. At scoping level, it's always equity level, and I think I'm happy to be corrected, but I think under the regulations checklist, it has to be 100% equity assumed. Obviously, if we debt fund it, that provides more upside, as the rate of return is better than the cost of actual debt. And that'll be incorporated with ultimately the feasibility study. So the answer is it's currently 100% equity, but by the time we get well and truly in the feasibility, it will assume debt finance to the level of our discussions between early next year and when we complete it.
Just another one then. So are there any benefits for BlackEarth in terms of reduced CapEx or de-risking Mineri from the infrastructure work that will be done by next source materials at Molo?
Yeah, that's a good question. The port is already there. It was kindly built by Rio Tinto about 10 years ago. It's a first world port. You can look it up. It's Port de Fin. It's a deep sea port. It has 15-metre plus draft, 2 berths. So you can literally get whatever size ship you want in there, and it's only utilised 3 days a week. So, there's plenty of room to be able to use the services between Molo and ourselves. Molo will use we'll probably have a common road for about 30%, 35% going to our respective projects. After that, we'll have our own roads going to the sites. Our road is pretty well in place anyway, so that's the problem. And look, I mean, it does make sense, and without talking out of school, we do talk to them on a fairly regular basis to see what we can do together for mutual benefit.
Thanks, Tom. And just finally, so what are you most excited about for the coming months?
In the coming months, I think I'm particularly excited about the DFS and where that's headed. So we'll give an update shortly, but I have to say that the sort of things I'm seeing incorporated under Nick Ryan's stewardship, it makes it an extremely attractive financially project, but it's also technically very robust. So we'll be telling people more about that as we go along. From an ESG point of view, having personally undertaken the audit for both the corporate and asset side, I have to say I'm particularly proud of that. So I'm looking forward to the market impressions of once that independent assessment is done and coming out to the market. And I think there are two key things. And then obviously, as we head more into exploration into the probably late Q1 and moving forward, is unearthing even more tonnes and higher grade material heading in that northwest area. So they're the things that excite me. And obviously, stepping out a few more months into this time next year, the Indian joint venture and putting us in cash flow will be a great position for the company to raise its brand as a graphite producer, etc., and truly get revalued in the global market space.
Wonderful. Well, thank you for joining us all for the BlackEarth Minerals Investor Webinar. If we've missed any questions, please feel free to reach out by the details on the bottom of our ASX releases. Tom, thanks for your time.
Thank you very much, Jane.